Welcome to Charts and Coffee. Happy Monday, everyone. Hope everyone is doing great. We've got FOMC week. So all of this week is going to be about Wednesday, 2 p.m. and then the 2:30 presser. What that means is when I look at where price action is sitting at, on one hand, we know rates are going to continue to go higher to, well, let me show you what I mean, because this is huge, gang. This is where understanding how to measure macro and how unbelievably simple it is will help. Everything is about December, and I'm going to grab my drawing tools here. Here we go. So everything is about December. So that's the target rate probability for the 14 December meeting. What this means is not that I'm looking for rates to be hiked, right? That's not the rate hike. That's where we're going to be. That's the plan as far as where the Federal Reserve is taking rates to. One thing that was really interesting, and if you're wondering, why was the market up? Gang, we can talk about all this other gobbledygook, but it really lands on, you know this to be true. We know the main macro is what is the Federal Reserve going to do. We all know what accommodative a prolonged period of low rates has done to the stock market. We know what low rates does. We know what having cheap money does. So as money gets more expensive, the question is, how expensive is it going to get? The less expensive it stays, the happier the stock market is going to be. And right now the market is a little happy because what this column, where we're likely going to be come December, is 1/4 point less than what we thought, say, 7 to 10 days ago. So the battle seems to be occurring between whether or not we're at 3.5 to 3.75% or 3.25 to 3.5. So when people ask, Rog, what do you think about jobs? My answer, how does that affect the December 14th target rate probability? Raghee, earnings, that doesn't matter. Not really. Are they great trading opportunities? That's a whole different conversation. But what does it mean to macro? Pretty much nothing, gang. Growth, jobs, inflation. And if you're looking to measure anything else that the market is digesting and you want sort of the punchline, this is it. This is how easy it can be. Gang, being a trader at 32 years, going on 33 at this point, being quote unquote advanced is not more and complexity. I thought that probably my first 10 years. I've got to be fancier than this. I've got to find things more than support and resistance levels and 50% levels and simple patterns. Oh no, clearly sophisticated traders, professional traders, much more complexity. It really isn't. It's doing the things that worked and just doing more of it. Having a bigger watch list, having mastery across multiple asset classes. It isn't more. So part of your brain is going to fight me on this, and that's okay. That's totally fine. As one of my mentors used to say, listen to me now, believe me later. This is going to be the way in which we measure what that other stuff, growth, inflation, jobs, actually means to the Federal Reserve, not the economy, the Federal Reserve. This is why equities are up. And if this continues to increase in probability, the equity markets will be in a really good mood because that's 1/4 point less hike. This is the game right here, gang. Now we want to continue to monitor this into Wednesday, into 2 p.m. and then after 2 p.m. Well, actually after the press conference. And then we'll see where we are. And this is going to be rinse and repeat. There you go. There's your macro lesson. Gang, we can really keep it this simple. Now, if you want to make it more complex, that's fine. But realize at some point, it's just because you want to. Believe me, gang, I've been there too. The simple stuff works. We just scale it, right? And I get a lot of questions about that. Rod, can I read a book on macroeconomics? What would you recommend? And I'll recommend the same book that I've probably been recommending now for a couple of years. And that is The Holy Grail of Macroeconomics, which is actually a fairly decent size, but not thick, paperback about really Japan, the Japanese economy, because it's the one that's embraced extremely low rates for an extremely long period of time. And it does map to an understanding of where we are now. So it's a cool book. Unnecessary, though. If you like to read, if you're a market geek, especially a market history geek like myself, you'll love it. If not, do you need it? Just use what I just showed you. All right. So as always, gang, this show is about your questions. So let's jump on into it. All right. So let's grab the first question here. And all right, here we go. I'm trying to find, there we go. That's what I want to do. Make sure y'all can see the date when we pull up the questions. Okay. So the first question is for short-term swings, 1 to 2 weeks. I don't look at short-term or longer term. I just look at swings, by the way, Robert, just swings. I don't try to predict time horizon. I just embrace what the potential could be. So for swings, what time frame would I use to set up my trade? Daily, always daily. I either have a 5, let's go back to simplicity for a second, which is, gang, I can say this because I've been doing this for so long, but I will also say it's really tough. The desire for a new secret squiggle, the desire to go beyond price, time, volume, and volatility. That is all. And if you take a look at the tools that I've released, most of them free over the years, they're all going to come back to price, time, volume, volatility. Anything beyond that and a whole lot of redundancy in each one of those pillars, if you will, becomes overkill. How many ways do we really need to crunch price, right? I mean, really, how many ways? So you'll notice this is going to be the last 4 years. I have not released a single new price indicator because we don't need another one. What I've released are volume indicators and volume and volatility indicators. And I continue to teach the value of understanding a day trading clock or hot zones on the calendar, which, by the way, that's free. It's just observing what time it is and a good economic calendar like Forex Factory or Trading Economics. So when I'm looking at time frames, the same hopefully simplicity is going to apply. For a lot of years, gang, I looked at up to, oh gosh, in my most ridiculous phase, probably 8 different time frames. And in my less ridiculous phase, about 5. Now I look at 3. 1 for day trading, 1 for swing trading, 1 for my position trades, aka my portfolio, my investments. 5 daily, weekly. The rest is noise. And why do I say that? Because Rag, you're flying in the face of lots of traders who believe in multiple time frame confirmation and does the 5 agree with the 15 and the 30? And oh my gosh, here's the thing. That doesn't guarantee anything. It just means that we're starting to see a trend. And if the daily time frame has organization, the intraday probably does as well. But here's the real danger in that. Not that there's no value in it, but here's the real danger in that. We're human. We're going to start to cherry pick the time frame, and not in a good way. We're going to start to look for what agrees with us. We're going to go into the fallacy of, are we bullish because we're long? That's what most traders are. Or are we long because we're bullish? And the multiple time frame confirmation approach allows us to cherry pick whatever agrees with us, whatever agrees with an open position we have or an open position we want to have. So 5 daily, weekly, that's it. All right. You found that slow stove video to be a big help? Oh, very cool. So I will, hang on, I can post that here again for some of you that might have missed that. This has been something a lot of folks have been asking me for, which is, okay, Rag, we know you talk about the secret squiggle on TOS, which is free to find overbought and oversold markets in a neutral environment. I haven't found anything that I have used for as long as a good old-fashioned 21K 3D slow stochastic, and even better, it's built into just about every platform you're ever going to use. So I just push that through in the general chat. You'll see that push through, and then I guess I can, hey bot, I guess I can star it or something, so it pins or some such thing. All right, cool. All right, so hopefully that works. Thank you for the question, Robert, because it's a really important one. It's that basic stuff that makes the most sense. James, again, please limit your questions to maybe one symbol. I'll take your first one here, James. I have a hard enough time getting through to everybody's questions, so I do appreciate that. Do I like Philip Morris for buying puts? Love it. Is it a swing? Yes. Is it a downtrend? You got it. Double red, bearish momentum, bearish trend. So say the classic 8, 13, 21, and 34 EMAs. Look for puts. Look, we've got earnings in the rearview mirror. So I would now start to look at Philip Morris. Keep an eye on XLP, but I do like that setup. You got it. All right, next up, Nick asks, what's the most trades that I typically have active at one time? For day trades, probably no more than 4, and that's pushing it. I don't like to have more than 4 to 6 day trades on at one time, and that's a lot. I would prefer most traders have 2 to 4, 2 preferably, maybe 3. For swing trades, up to 9, and that's pretty comfortable because again, if we're swing trading on a daily time frame, 1 new candle per day, not decisions to be made every hour of the day, the way we might have to in a 60-minute time frame, for example. So 9, up to 9 swing trades, very common for me. And then portfolio, I'll usually limit the best 9 to a theme. So I stick with 9. Is there any magic to that number? Probably not. It just seems to work for me really well. And I typically have no more than 45 positions in my overall portfolio. And that means I'm going to be looking at about 5 different themes. So I try to find the best 9 stocks, if that many, for each sort of theme. And then, so I think of a theme, investing theme portfolio, and I'll have up to 5 of those. And I'll try to find the best in that. So yeah, I'm a big fan of, I just have noticed, I didn't think about 9 consciously. When I went back and studied how many positions I tend to put on as a swing trader and as a building individual portfolios, I just kept coming back to 9. So I just, an accidental coincidence, but it works really well. And it does 2 things. It doesn't spread my attention too thin. It doesn't spread my capital too thin. And I'm having to pick the best. So once I realized it was 9, think about how many ball players take the field in baseball. You put your best 9 players on the roster. You put your best 9 players on the field, and having that limit forced me to become discerning, forced me to say, do you deserve to be out in center field today? Do you deserve a spot on the roster? And that's the way that I look at that. It just kind of accidentally ended up being 9. Gang, I think a lot of times traders want to sound like we're just so methodical and everything is so calculated. No, sometimes these are just where our comfort levels land us, and then we observe what worked. We don't try to shoehorn ourselves into this discipline that someone else has. No, we just kind of focus on what that comfortable, effective overlap is. All right, next up, when initiating a swing trade, what information do I write down? When I initiate a swing trade. So there's 2 things I can do. I'm a big fan of index cards. So my swing trades are going to start on a little card I get. I know I could probably do this myself, but I really like the way it's printed out. It's called 3x5 Life. Has, if it's my personal card, this is a personal one. It's going to have my agenda for the day personally, but if it's my trading one, it's going to have open positions or names on the watch list. It's going to have hot zones that I want to be aware of for that day. And then I could put notes on the back. So that's one way to do it. If not, in my planner, the basic stuff, catalysts, what's going to get me to my trigger? Of course, the trigger itself. And at that point, I will already know what my budget is. You can write the budget down. How many dollars worth of options? And then ultimately contracts are you going to buy? I'm going to write down, simple stuff, expiry, strike, put, call. What then my paper cut or point of validity stop loss is. So I've got a paper cut, percentage based, or I have a point of validity price based, technically based stop. So I might write down both. And my first, at least, if not second, targets. That's, all the things I need to understand what all the price levels are and what all the dollar or percentage levels are that would keep the trade valid, keep the trade at a point where I can still hold it, stop me out, or scale out. So those are the levels that I'll write down. All right, next up, curious on my views of the euro dollar futures. So euro dollar. So Chris, yeah, if you look at the GE, so euro dollar, gang, and Chris, I know you know this since you asked the question. Euro dollar is basically a dollar in a European bank. Now it doesn't. It means more than that now, but it's an interest rate tool. It's an interest rate contract. So what does a dollar invested outside the US in a European bank, what is it yielding? So you have that GE. Now, that's not to be confused with the Euro FX or the Euro versus US dollar. I like the Euro dollar to move mostly with what I'm seeing on ZB, Chris. But it's doing its own thing, because remember that the US has been in a tightening cycle. And at this point, I would say a mature one. When is a tightening cycle mature? My rule over the years, over the decades, has been when we're halfway there. When I know what the target rate probability is and we're halfway there, which we are, and then some. So we're more than halfway there. Mature. The ECB, the European Central Bank, is really at the beginning stages of that. So we could see more, we could see higher yields from the GE contract. And that's what I'll be looking for. Short the rip. Yeah, short the rip. Let's see. Next up is, do I see XLF at an entry point for a put? All my cards on the table, Dustin, I'm already long a put. So there's kind of your answer. Yeah, I'm already long a put there. Yeah. When I refer to price indicators, can I explain that? Sure. Whenever we have an indicator like a slow stochastic or exponential moving average, what is the formula for the indicator? Every indicator has a formula. If I'm taking or prioritizing open, high, low, and close as the reason for some arithmetic or whatever, algo, right? If I'm using open, high, low, close as the inputs to spit out what this indicator is going to do, that's a price-based indicator. If the inputs are volume, think volume weighted average price, where the priority is volume, then distance second price. If it's a volume prioritized indicator, what is volume doing? Therefore, that is going to then be the output for the indicator. That would be a volume based. For those of you that are familiar with my HPMRs, why do these red and green zones plot? Because my process that I created about a decade ago looks at the number of points a particular contract or futures contract, Forex, stock, ETF, crypto, you name it, looks at how many points we move during that hour. So that's a volatility. So the inputs are going to spit out volatility. So I'm not looking at open, high, low, close. If we're looking at open, high, low, close in some kind of combination, that's price-based. 90% of what you have on your charts is probably price-based. You probably have a redundancy of price-based tools, which is not a problem as long as you understand when to look at them and not look at them. Some tools are very good for breakouts. Some tools are very good for open high, for overbought and oversold. Some tools are great to find dynamic support and resistance in a market. Some tools will automate support and resistance in a market. The problem is, and I very seldom see an exception to this, most traders have the same tools on their screen, as do I, but they always look at what all of them have to say. And that, I can tell you with utmost confidence, is categorically wrong, right? I will not look at a slow stochastic in a trend. An oscillator should have no attention from me in the context of a trend, because it's an oscillator, right? An oscillator is always looking for overbought and oversold. Remember that a trend is the embodiment of a prolonged period of overbought or oversold. It's imbalance. That's why we have a trend. So, these are mistakes that usually new traders make. I used to make them once upon a time until I realized, just like if I'm golfing, all the clubs are valuable, but each shot has a club that would be best for it. So I hope that makes sense. We need all four factors covered, ideally. And then ultimately, we get proficient at picking the club out of the bag that we need for the shot. And there is no exception to that one, gang. That is the way indicators work, because they're all measuring things for a specific environment. So if you have a new secret squiggle, maybe I've given you one, but the first question you should ask me is, Rog, when do I use this? And if I ever say all the time, unless it's a tool whose job it is to understand the overall environment. For example, the wave or the grab or the trade flags. They're not necessarily telling me when to get in or get out. They're just telling me what the weather's like. There are those tools as well, right? And most traders actually don't even have those. But if you have some tools that its only job is to tell you this is the environment, not when to get in necessarily, that's fine. But after that, if you have a tool that tells you when to get in, when to get out, and you're always using it, you're probably overusing it, because there will be environments where it's just not applicable. All right, last question for our show today. What is the relation between ETF indices and stocks? Does buying the ETF push the underlying stock up? Yes. Does buying the stock push the ETF? Yes. It's definitely very sympathetic. It's definitely symbiotic. Yes. Yes to both. The thing that I'll add to that, Jochen, is the weighting of the stock in the ETF is going to disproportionately influence that ETF. And the weighting of the stock in the index, same thing. And the weighting of the sector within the index, again, higher the weighting, more it's going to have an influence. So, all right, gang, that is our show for today. As always, gang, thanks so much for caffeinating and dominating with the crew. I will see you all tomorrow. Same time, same station. Be good to each other, gang. Remember, FOMC on Wednesday. Everything else falls a distant 22nd to that huge event coming up. All right. Talk with you soon.